the whole of the fiat currency system post Bretton Woods is now running out of time. The reason that China has accumulated gold and Russia is doing it so as well, quite simply, is because under Marxist theory, they reckon that capitalism is doomed and the currencies will be doomed with it. The only protection which they understand, and of course you and I understand, is to tie the value of their credit, yuan or rubles or whatever it might be, to gold. And if you tie it irrevocably to gold, then you protect yourself from the mess that we in the West have got ourselves into.
Silver just wrapped up its worst week since 2020, plunging over 13% as investors weighed deepening recession risks, widespread forced liquidations, and growing concerns about industrial demands. The steep decline reflects the mounting stress in global markets, with U.S. trade policy, especially under President Trump, reshaping expectations for silver's future. His sweeping reciprocal tariffs and focused measures targeting China have prompted a re-evaluation of global supply chains and manufacturing outlooks. Semiconductor-specific tariffs are particularly concerning for silver, given the metal's heavy industrial usage. China's retaliation, a 34% tariff on all U.S. goods, has intensified fears of a prolonged trade war, dragging down demand expectations across Asia and Europe, both of which are key industrial consumers of silver. Equities also suffered a sharp correction, with Dow futures tumbling more than 2,000 points, triggering margin calls and a broad wave of selling. Silver got hit especially hard as traders liquidated positions to raise cash and cover losses in other areas. Unlike gold, which retains central bank and monetary demand support, silver lacks those buffers, so the sell-off was more severe and longer lasting. The pressure on silver was further amplified by a stronger U.S. dollar and rising real yields. Treasury markets regained footing after solid jobs data, pushing the 10-year yield close to 3.88%. As expectations for aggressive Fed rate cuts eased, the dollar firmed up, weighing even more on silver. All eyes are now on this week's Fed minutes and Thursday's CP. I report two key events that could shift policy expectations. If the minutes show any reluctance to cut rates or if inflation comes in higher than forecast, silver may face renewed downside from tighter financial conditions and continued dollar strength.
I think the American banking system is giving a problem to what we in England call the SMEs, the small and medium-sized enterprises. They're not lending. They're not providing the liquidity that businesses need. And the reason for that is they see risk. We've seen with the commercial real estate business, for example, in various other areas. This is something that bankers just don't want to know now because they see risk. Business out in outside the main conurbations is not good. So what they're doing basically is they're lending money to the government, and they're lending money to by buying T-bills. I mean, they can't destroy credit once they've created. This is the problem. The only way credit gets destroyed is when people go bust and they default. So they're stuck with credit. So what they're trying to do is they're trying to move the credit from risk to what the regulators say is non-risk. In other words, you're looking at short-term finance for government. And that's basically what the banks are doing. Now, interest rates will rise, and I can explain why. I think that's a separate question. The consequences for that will be huge, great problems developing for the entire financial system. I mean, I can see the equity market bubble bursting completely. I think President Trump's tariffs, I call those Smoot-Hawley Mark II, basically. And if you think about it, 1929, we had a credit bubble which bust. That was the Roaring '20s. And we had Smoot-Hawley at the same time, which was legislated, or it was signed into law by Hoover in 1930. It was that combination, basically, that killed the global economy. And here we are going down the same route. This is important because the banks basically are the guys, if you like, who are taking the risk on this. And but at the end of the day, of course, we don't want our banks to go bust, and the central banks will do what they can to rescue them. But Andy, there's another problem, and that is that the central banks are all deeply in negative equity. People think that it doesn't matter because they can always print their way out of trouble. But yeah, if they do that, they collapse the currencies. And there is another problem, and that is that if they don't print their way out of problems, then they have to turn around to their major shareholder, which in this case is governments, for finance. But the governments themselves are in a debt trap. So the governments, the whole situation actually is all it's all set to fall over. That's the trouble we face. And that's why it's so important to understand the difference between money and credit. Money being gold, credit being everything else.
Meanwhile, gold also saw a pullback amid the broader market turmoil, but the underlying fundamentals remain intact. Global markets opened the week under heavy pressure, with stocks selling off across the board. Volatility surged, particularly in the Asian session, after China hit back with new tariffs, further escalating the fallout from last week's Liberation Day tariff shock. Hopes that tensions would ease quickly faded, replaced by growing fears that the U.S. could be leading the world into a recession. This risk-off sentiment sparked mass liquidations across asset classes. Even safe havens like gold weren't spared, with XAU/USD falling more than 6% since Thursday. That move defies the metal's traditional role as a hedge in turbulent times. But rather than signaling a fundamental breakdown, the drop appears to stem from forced-selling investors offloading winning or liquid assets to meet margin calls and reduce exposure. Despite the panic, the broader picture for gold remains strong. Uncertainty, central bank caution, and persistent volatility still support a bullish medium to long-term outlook. Just last week, Fed Chair Jerome Powell reiterated a cautious stance, signaling a wait-and-see approach amid the current instability. The upcoming CPI data will be a key test. If inflation cools further, it could reinforce the case for eventual rate cuts, lifting gold once again. However, a surprise spike in inflation could delay easing, adding yet another layer of complexity to an already volatile market.
If you like, being offered the option to subscribe for US Treasury debt, he will start thinking, okay, if I'm going to buy this debt, what's going to be the purchasing power of the currency which I have to buy in order to buy this debt? Now, if the purchasing power of the currency is going to decline by, say, in my estimation, say 5 or 6%, then quite frankly, to get a 4.3% yield on the 10-year proposition, forget it. No, it's got to rise. And the other problem that we have, I mentioned a debt trap. When you get a situation where GDP is growing at a slower rate than government debt, basically the basis in which government debt is financed, or government finances are financed, is basically the revenue base, which is proportional to GDP. And if that's not growing as fast as the debt, then the debt is basically running away with the situation. It's called a debt trap. And that's really where the US government is. And it's not just the US government, it's most of the major G7s, with the exception so far of Germany. So, that's why interest rates rise. Let's look at it another way. Imagine that this is 1923 and you're in Germany. The economy is in such a mess. It's horrid. It really is horrid. So how does the government rescue things? Suppresses interest rates to zero? What? The interest rate is a reflection of the development, if you like, the evolution of the purchasing power of the currency. And if the currency is going down, and this is what gold is telling us, actually, we don't need me to tell anyone, gold is telling us the currencies are going down, then interest rates have got to go up. It's actually quite simple. And we've got a real problem because it's not just, you can't sort of just wave a magic wand and say, oh, well, just put the dollar back on the gold standard. The problem is that the US Treasury is invested in getting gold out of the monetary system entirely and has been describing as a pet rock or whatever. And not only that, but the entire intellectual economic establishment believes in sort of, if you like, macroeconomics, Keynesian and monetary, but particularly Keynesian. And they've got to be persuaded off that. I mean, the whole of the macroeconomic thing is basically a non-science. And so you've got to re-educate the entire establishment.
That was Alasdair Macleod's perspective on gold's evolving role and the bold ambitions of the BRICS nations to build a gold-linked financial framework. Could this vision truly reshape the global economy, or are the hurdles simply too high? Let us know what you think in the comments. And if you're enjoying these recaps, don't forget to like, subscribe, and turn on notifications. There's more to come. Watch this next video. It's tailor-made for you. See you there.